All right, diving in this week, and you sent over this article, and I got to say, it got me thinking. This whole idea of dividend investing, it feels like it's having a moment, maybe even like a bit of a renaissance.
Yeah, I see what you mean. I mean, looking at what you sent over, there's definitely a shift happening. Like we're moving away from all that hype,
Yeah.
all that speculative stuff. And this whole dividend thing, it's looking pretty good right now.
Yeah, exactly. It's like back to basics, solid companies, steady returns. And I was struck by something in the article. It pointed out that dividends have actually contributed a huge chunk of the stock market's total returns historically.
Oh, yeah.
Yeah, like 40% of the S&P 500's total return since like 1930. That's pretty significant. And especially now, with inflation still kind of sticking around, getting those regular dividend payments, it can really help, to keep up with the rising cost of, well, everything.
Makes sense. Steady income, especially when prices are all over the place, it's got to be reassuring. But I feel like, for a while there, dividends weren't exactly the hottest topic.
Right. It was all about the next big growth stock, the moonshot, the whatever.
Yeah, exactly. I mean, when interest rates were like rock bottom for so long and borrowing was super cheap, yeah, it makes sense that growth was the main focus. But as your article points out, things are definitely changing.
Okay, so let's get into that change. The article really digs into this idea of rising interest rates. And I'm curious, from your perspective, how does that actually create opportunities for someone who's, thinking about dividend investing?
So rising rates, they're kind of a double-edged sword, right? Like on the one hand, they've definitely put pressure on valuations, especially for some of those classic dividend-paying companies.
Yeah, right.
Think utilities, telecoms, REITs, even consumer staples. Their stock prices, they've taken a bit of a hit, and that's actually made their dividend yields look way more attractive.
So it's like a sale on solid income.
Exactly. Like suddenly these reliable companies they're offering you a better deal. And the other thing is, and your article talks about this too, it's like there's this renewed focus on actual profitability, on consistent cash flow.
Yeah, like show me the money, right? Not just promises.
Totally, because borrowing's gotten more expensive. Right. So investors they're less interested in companies that are just burning through cash. They want to see real earnings, and importantly, they want to see companies actually returning some of that cash to shareholders,
Right.
through dividends.
It's a back to basics kind of thing.
Yeah, for sure.
Now, the article also mentioned something about bonds becoming more competitive as interest rates go up. How does that play into the whole dividend investing picture?
So, think about it this way, right? As bond yields rise, they start to look a bit more tempting for investors who are looking for income.
Right, yeah.
So for dividend-paying stocks to stay competitive, especially those that have a history of not just maintaining but growing their dividends, they got to offer something extra.
Yeah.
Like the potential for both a steady income stream and the chance for that income to actually grow over time, along with potential price appreciation.
So it's not just about the yield at this moment.
Exactly. You got to look at the total return, the combination of income and potential growth. That's key.
Got it. Now let's get specific. The article dives into some sector specific opportunities, and this is where it gets really interesting. Let's start with REITs, real estate investment trusts. It says they've been hit pretty hard by these rate hikes. So why is that, and where's the opportunity for dividend investors?
So REITs, they're kind of unique. They're often very sensitive to changes in interest rates because, they use borrowed money a lot to buy and develop properties.
Right.
So when rates go up, their borrowing costs go up too, right? And that can squeeze their profits and sometimes even make their properties seem less valuable on paper.
Makes sense.
But here's the thing, and this is what your article points out. This sensitivity has actually created a kind of a weird situation. Like right now, a lot of REITs, especially the well-managed ones, they're offering these really high dividend yields, like 5 to 10%, which is pretty amazing.
Wow.
And on top of that, some of them are trading at huge discounts, like 30 to 40% below their net asset value.
So what does that mean exactly?
It means the market might be like undervaluing their actual properties, and that could be a huge opportunity.
Interesting. So you're saying it's like a fire sale on real estate, but through REITs?
Kind of, yeah. But here's the caveat. Not all REITs are created equal right now.
Right.
The article, it specifically mentions industrial REITs, data center REITs, and healthcare REITs as being, potentially more attractive.
And why is that?
Because those sectors, they're driven by really strong demand,
Right.
Like, think about e-commerce, right? It's booming, and that means more warehouses, more logistics space, which is great for industrial REITs. The article mentions Prologis PLD as a good example there. And then data centers, they're essential for everything digital these days, right? Data storage, processing, all that stuff. And then healthcare REITs, well, with an aging population, the need for medical facilities and senior housing, it's only going to grow.
Okay, so focusing on those specific types of REITs.
Yeah, that's the key. Now, the article also mentions Realty Income, ticker symbol O. They're famous for their monthly dividend payments, and they have a really diverse portfolio of properties.
Oh, yeah, I've heard of them.
Yeah, and then there's WP Carey, WPC. They had a bit of a dividend reset recently, but the article seems to think they're poised for recovery, especially with their long-term leases and global reach.
So some interesting specific opportunities there.
Yeah, for sure.
Now, moving on, the article talks about high-quality dividend aristocrats. That sounds pretty impressive. What exactly makes a company a dividend aristocrat?
Think of it as the Hall of Fame for dividend payers. These are companies in the S&P 500 that have not just paid a dividend, but have actually increased their dividend payout for at least 25 years in a row.
Wow, 25 years. That's commitment.
Right. It shows stability. It shows they can generate cash flow even when, the economy is doing crazy things. And it shows their management is serious about returning value to shareholders.
Yeah, that makes sense.
The article mentions some big names, Johnson & Johnson, J&J. They've got like a 60-year streak of dividend increases, that's just mind-blowing.
Well,
And then there's PepsiCo, PP, over 50 years, and even 3M, MMM. They've had some rough patches lately, but they still offer a pretty high yield, especially if you're okay with a bit more risk.
so these are companies that have really stood the test of time.
Exactly. They've weathered recessions, they've weathered market crashes, and they've kept those dividends coming. In this kind of uncertain environment, that can be really appealing, I think.
All right, so next up, the article talks about utilities and infrastructure. We talked about how rising rates might have affected them initially, but it also hints at some interesting long-term growth opportunities.
Yeah, so utilities, they've always been seen as kind of a safe, steady investment, right? They pay consistent dividends, their businesses they're regulated, they're not, super volatile. But when bond yields started going up, some investors, they kind of jumped ship. But the thing is, the demand for what they provide, electricity, water, gas, it's not going away. In fact, it's probably going to keep growing. Plus, and this is what your article points out, there's this whole renewable energy transition happening, right? And companies that are investing heavily in that, like NextEra Energy, NEE, they offer a really interesting combination of current yield and potential future growth. Like, as those renewable projects come online, their earnings should grow, and their dividends could grow with them.
Okay, so there's a long-term play there.
Definitely. And then you've got your more traditional utilities like Duke Energy, DUK. They still offer a solid yield. Mm-hmm. And then there's Brookfield Infrastructure, BIP. They're more global. They've got, data centers, toll roads, all sorts of infrastructure assets. So you've got options within that sector.
Got it. Then there's financials and insurance.
Yeah.
The article seems to think they could actually benefit from this higher interest rate environment. It's kind of counterintuitive.
Yeah. So for banks and insurance companies, higher rates can actually be a good thing, because when rates go up, they can make more money on their loans and investments.
Right.
Now, the article does say there might be some challenges, especially for smaller regional banks, but it suggests focusing on larger, more established banks, the ones with, strong balance sheets, like the Toronto Dominion Bank, TD, for example.
Okay, so sticking with the bigger players.
Yeah, generally speaking. And then on the insurance side, companies like Chubb, CB, they've got a great reputation for their underwriting. Mm-hmm. And then there's Aflac, AFL. They've got a really impressive track record of dividend growth, like 40 years in a row.
Wow.
So even in those sectors, you can find companies that are really committed to rewarding shareholders.
All right, last but not least, let's talk energy. This is a sector that's definitely been volatile lately, but the article points to strong cash flow and good shareholder returns.
Yeah, so the spike in energy prices we saw, it really benefited a lot of energy companies. They're sitting on a lot of cash right now, and the article highlights companies like ExxonMobil, XOM, and Chevron, CVX. They're using that cash to pay dividends, to buy back shares, and their dividend payout ratios are still pretty low, which means they've got, room to keep those dividends coming.
So they're not stretching themselves too thin.
Exactly. And then you've got the midstream companies like Enbridge, ENB, and Enterprise Products Partners, EPD. They own pipelines and processing facilities, and they often pay really high dividends because, well, their businesses they're pretty stable, They've got long-term contracts.
Makes sense. Now, one thing the article really emphasizes is the difference between, just chasing the highest yield and focusing on companies that have a history and the potential for dividend growth. Why is
That's a great question. And it's something a lot of investors they kind of get wrong. See, a really high yield, it can sometimes be a warning sign. Like it could mean the company's stock price has tanked because of, some underlying problems, which makes the yield look artificially high.
yeah.
Or it could mean the dividend is just not sustainable. They're paying out more than they can really afford, and they might have to cut it later.
Yeah, that wouldn't be good.
No, not at all. But dividend growth, it's different. It usually means the company's doing well, their earnings are growing, and they're confident enough to share that growth with shareholders.
Right.
Plus, when those dividends grow, it helps you keep up with inflation,
Yeah.
And if you reinvest those dividends, it creates this amazing compounding effect. Like your returns just keep building on themselves. It's like a snowball rolling downhill, getting bigger and bigger.
That's a great analogy. The article mentions some companies that are doing well on the dividend growth front, even in sectors you might not expect, like technology.
Yeah. They mentioned Apple, AAPL, for example. They were all about growth for a long time, but now they're really increasing their dividends. And then you've got companies like Texas Instruments, TXN, in the semiconductor industry. They've got a great track record of dividend growth. And even Home Depot, HD, which, they're tied to the housing market, which can be up and down, but they're still a dividend growth machine.
So there are opportunities out there, even in sectors that aren't, traditionally thought of as dividend plays.
Absolutely. The key is to look for companies with strong businesses, good management, and a commitment to sharing their success with shareholders.
So let's say someone's listening to this and they're thinking, okay, I want to build a dividend-focused portfolio. What are some actionable steps they can take based on what's in the article?
Well, first off, diversification, right? Don't put all your eggs in one basket.
Right, of course.
You want to spread your investments across different sectors, maybe some high-yielding REITs, some dividend growth stocks in tech or industrials, some more defensive plays in consumer staples or healthcare. It's about balancing things out.
Yeah, building a well-rounded portfolio.
Exactly. And then the article talks about the payout ratio. You got to pay attention to that. It's basically how much of a company's earnings they're paying out in dividends.
Okay.
Ideally, you want that to be, somewhere between 40 and 60% for most companies. REITs and MLPs can be a bit higher, like up to 80%. But if it's consistently really high, it could be a red flag. Like maybe they're paying out more than they can really afford.
Right. Yeah, that makes sense. The article also mentions dividend reinvestment, right?
Yeah, that's a huge one. The power of compounding, it's incredible. Like when you reinvest your dividends, you're basically buying more shares, which means you'll get even more dividends in the future. And those dividends buy even more shares, and it just keeps growing and growing. It's amazing.
It's like free money almost.
Well, not exactly free, but you know what I mean. And the article also reminds you to think about taxes.
Right.
Qualified dividends, they're usually taxed at a lower rate than regular income. But income from REITs and MLPs, it can be a little different. So, it's worth talking to a tax advisor to make sure you're doing things in the most tax efficient way.
Definitely good advice. Now, beyond just the financial side of things, the article talks about the psychological edge of dividend investing. What do they mean by that?
I think it's about the peace of mind that comes with knowing you're getting those regular payments, and especially when the market's going crazy, those dividends, they're like a steady anchor.
Yeah, I can see that.
And for people in retirement or getting close to it, dividends can provide that income they need without having to to sell their stocks. So it's less stressful. You don't have to worry about timing the market or anything like that.
It's about stability.
Yeah, for sure. And there's even some evidence that dividend-paying stocks tend to be less volatile overall. They tend to weather those market storms a little better.
So it's not just about the income, it's also about the psychological benefits.
That's exactly.
Okay, so big picture. What's the main takeaway from all this? What's the message the article is trying to get across?
I think it's saying that right now, with rates going up and investors focusing more on fundamentals, dividend investing, it's got a real chance to shine.
Right, yeah.
Like there are good companies out there trading at reasonable prices, offering solid yields, and they have the potential to grow those dividends over time. If you're looking for a way to build wealth steadily, to create a reliable income stream, dividends, they're worth a serious look.
So it's about tuning out the noise, all that short-term hype and focusing on the long game.
Absolutely. Find those companies that are committed to their shareholders, that have a history of sharing their success, and then, let those dividends do their thing.
That's a great point, and I think that's a really good place to leave it. Maybe a final thought for our listeners, think about how adding a well-thought-out dividend strategy to your portfolio could not only boost your returns, but also, give you a greater sense of control, of stability in your investing journey. Something to think about, right?
Absolutely.
All right. Thanks for joining me for this deep dive. It's been great.
Yeah, thanks for having me.
And to our listeners, as always, keep those questions coming. We'll see you next time.